Volatility is again on the rise in the markets as the dramatic fall in the price of oil continues to shock global markets, with a new 12-year low in Brent crude below US $30 a barrel before a slight recovery, and similar levels for the other primary oil indices, which all seems to have been interpreted lately as a measure of recession risk and a forerunner of a global downturn. But just how negative is a collapse in the price of oil? In previous periods of falling oil and energy prices, this has been in line with a sharp fall in demand, for example in the GFC and after previous boom-bust cycles, especially associated with global recessions. This time, however, it is more a function of a huge glut in supply through shale oil, increased supply from OPEC members, and most recently with Iranian sanctions being lifted. What about the demand side? Certainly there are signs demand from China, not just for oil, but for a range of commodities, has fallen. And the outlook for Chinese growth remains the big question mark for the global outlook. But as the chart shows, consumption has actually been increasing almost as sharply as production over the last three halves. And so this doesn't appear to be a sign of falling demand. So the losers in this rout are clearly the oil-producing nations, with oil exporters such as Russia and Venezuela in deep recessions. But the winners are consumers, and the knock-on impact on retail trade and small business at the margin. For Australia, which is a net energy exporter, but not a net oil exporter, our issues are falling iron ore and coal prices. But here, the falling Aussie dollar is taking some of this pain. For the RBA, who meet on Tuesday, this is all unlikely to see an interest rate cut, as we are still seeing reasonable jobs growth and business and consumer confidence. Plus, we have an inflation rate in the sweet spot, the latest read at 2% core inflation. The big risk ahead from overseas remains China and emerging markets, and how these debt-inflated regions will cope with rising US interest rates and potentially falling liquidity. For the moment, this is a niggling worry rather than something the RBA will need to respond to directly. And finally, the latest VEDA Business Credit Demand Index paints a positive picture for Australian business lending, with the index having now risen for 6 consecutive quarters. So the low interest rates and lower Aussie dollar are keeping credit demand intact. And as long as the news from China doesn't deteriorate too quickly and equity markets can avoid a prolonged decline, we can expect more of the same in the next few months. I'll see you next week for the market update from Bendigo Bank.